Good evening, everybody, and welcome to the Marcellus webinar. Today, we are going to be discussing our consistent compounders portfolio, and we have our fund manager for the same, Rakshit Ranjan, with us. Hi, Rakshit. Welcome.
Excellent.
How would you like to begin, Rakshit? And then we'll see how this goes and take questions. I mean, rather, you'll take questions from me as we go through. And then, obviously, as everybody knows, at the halfway mark, we'll open it to the floor for questions. So Rakshit, over to you if you want to just set the stage of what we are discussing today, and then we will take it from there.
Sure. Thank you, Salil. Good afternoon, good evening, everyone. Welcome to our CCP webinar. Let me just start first by sharing the slide, and then, Salil, I'll just set the agenda. 1 second. Right. Salil, the slide is visible?
Yes. Go on, please.
Great. So, Salil, interject wherever you want to with questions. Happy to keep it free-flowing. So, I just want to highlight today a critical divergence we are observing in the Indian stock market. Now, when you look at the past couple of decades of investing in consistent compounders, historical fundamentals was a good reference point to understand the drivers of consistent compounding in a business in the coverage universe of this portfolio. However, these drivers of predictability in India of quality, they've evolved dramatically over the last 3 to 5 years, we believe, which then necessitates an update to the quality investing playbook of CCP. And today I'll walk you through how we have repositioned our portfolio to align with these structural shifts. So let us first start by reaffirming what has not changed, which is actually our philosophy. So our core CCP philosophy towards stock selection, it remains anchored in the search for consistent compounding of fundamentals. And that effectively means companies characterized by clean accounts, deep moats, and disciplined capital allocation, which are also available at valuations that reflect a neglect of either the quality of moats or valuations that reflect a neglect of growth drivers or of various optionalities that are likely to play out for the business in future. And when it comes to portfolio construction, CCP remains a concentrated portfolio with a very absolute return orientation towards portfolio construction. So that's the philosophy. Nothing changes on this.
Rakshit, sorry, if I can just come in here. I think most of our listeners, viewers would be very well aware of cleanliness, high growth, high-ROCE, predictability, and longevity aspects of the philosophy. But maybe to an extent, concentration also. On absolute return orientation, valuation, comfort, if you can just share some more thoughts on what does this mean for the investment strategy, and on portfolio construction specifically, if there has been any change in how you looked at it, as time has progressed.
Yes. So, portfolio concentration has remained unchanged in the sense that it is still a 15 to 20 stock portfolio. Although the constituents within that, they have evolved into being a far wider set of sectoral coverage, which I'll cover in a minute. When it comes to absolute return orientation, this is something that we always used to do, but probably didn't used to explicitly talk about. So in a concentrated portfolio where you are holding only 15 to 20 stocks, regardless of which benchmark you take, in any case, you are holding a very active weight in the portfolio relative to the index. Secondly, this was never a portfolio where proxies of what is there in the index were being bought in the portfolio. So it was always an absolute return orientation, bottom-up stock picking, fundamentals driving portfolio performance. Obviously, in the long run, if it doesn't beat the index, there's no right to survive, forget about right to win. So in the long run, it has to converge, whether it is a relative return orientation or absolute. But from a 1 to 3 year perspective, the portfolio is constructed bottom up rather than saying that, look, if in index banks are 25% weight, then banks or bank proxies in the portfolio should also be 25% weight, and so on and so forth, right? So that's something which I thought we'll put out explicitly. The valuation comfort piece, again, we've learned a lot. We've not talked as much about it, and in this webinar today we will. There's a 2 or 3 different facets of picking up valuation decisions in this portfolio. On the one hand, buying a trend when it was half of its today's price, but yet trading at 140 times P multiple was okay. On another hand, 10 times P multiple of a particular company where we are not comfortable with the fundamentals going forward will also not be okay. So valuation is certainly a focus area, but how do we pick up some of those aspects? I'll certainly cover in the subsequent slides. So let me first move to the fundamentals piece, and then we'll come to.
Sorry, Rakshit, before you proceed, I just want to inform people who have dialed in that even Saurabh has joined us today. So later, if there are any questions that you would like to post to him, put them in the Q&A box, and then we'll take, depending on the time we have. Sorry, Rakshit, back to you.
Sure, thank you. Hi, Saurabh. Okay. Now moving to the mechanics of our selection process. Now, as I had mentioned on the previous slide, we seek predictability and longevity of fundamentals in our investee companies. Now, predictability is an outcome of a few factors. Firstly, a large total addressable market, which is growing at a healthy pace, but has lots of inefficiencies that can be exploited. Now, these inefficiencies could be around unorganized players or incumbents offering poor service, or a lack of customer trust on, let's say, the product or the service provider. To pick up a quick example, so let's say packaged foods. It's a fast-growing subsegment of the FMCG universe, but unlike the rest of the FMCG universe, it's underpenetrated. And at the same time, there is a trust issue or a quality issue with some of the incumbents in packaged food, because the product has limited shelf life, and supply chains are complex, and you might actually get compromised service as well at times. So that's one example of the kind of TAM, or total addressable market, that we pick up. Secondly, the company must utilize its competitive edge to solve for these inefficiencies and thereby protect its market share, and also generate a high return on capital employed and cash flows hence. Now, quick example, let's say if you pick up the retail sector, there are 2 companies in our portfolio, Metro and Trent, where these companies, they offer relevance of products at low price points, and thereby they generate high ROCEs due to a process based on moats around inventory management. Now, this is addressing an inefficiency, because lack of inventory turns doesn't allow a business to make money, and hence pass on the benefits via low pricing in a profitable and sustainable manner to the end customer. Relevance of the product on the shelf also becomes a challenge for retail in general, and hence at one level it is a pretty simple solution, but a very difficult one to deliver, which is addressing the inefficiency. This kind of a hunt for a moat remains central, critical to every stock that we pick in the portfolio. And finally, the most critical factor on the left half of the slide that you can see, 2 distinct engines of capital allocation decisions from the management teams of our investee companies is what we seek. They do drive predictability of fundamentals in our minds. The first engine is the reinvestment of cash flows to gain market share in the core business. For instance, let's say if you look at the lenders or insurers in our portfolio, they largely rely on capital investment or reinvestment into their core businesses. And the second engine, the engine number 2, it involves deploying capital to build new moated growth drivers before the core business matures or saturates or stagnates. Now, there are several examples of this in the portfolio. So, for instance, even reasonably matured companies like Astral and Asian Paints, they are allocating capital pretty aggressively to backward integrate in a meaningful way. Another example can be of, let's say, hospitals. diagnostics, the healthcare piece, where players are expanding into new geographies to offset saturation in their core geographies from where the business started. And then there is an escorts with 10% or 5% of the market cap sitting in cash. There's a CMS sitting in cash with large chunks for either potential M&A opportunities or developing, let's say, export as a new growth driver for escort, as an example. So that remains the unchanged part of the philosophy. This flywheel has to be present. But whilst the principles of the philosophy have remained static, the environment within which these investee companies, they operate, it is fluid and evolving. And as a result, the correlation to begin with, the correlation between historical fundamentals and future predictability, it has weakened in the recent years. On the slide top right, you can see the Warren Buffett quote, which is quite relevant in that regard. What we are currently witnessing as a paradigm shift in the Indian economy is something maybe a smaller magnitude, but similar to what we witnessed in the early 1990s as a radical shift in the economy, which redefined quality investing for the next 3 decades, right? Which is the last 3 decades that we're coming out from. In the last 3, 4, 5 years, GST implementation or rapid adoption of interfaces like UPI and the behavioral changes that have happened post-COVID to both the demand side and the supply side of various businesses, they've either diluted or disrupted the old definition of moats in some cases. So for instance, when it comes to, let's say, distribution and marketing as a moat for a sector like FMCG, the larger players in FMCG historically had a key strength as their ability to reach 50 lakh outlets or 80 lakh outlets for their product categories. And they also dominated prime time television advertising slots to reach out to the customers with the brand pull. Today, platforms like Blinkit and Zepto, they've democratized logistics. A D2C brand doesn't need a 50-year-old brick and mortar network of 50 lakh outlets. It just needs a listing on a marketplace website. Digital marketing and video on demand has further lowered the barriers to entry for advertisement spends by FMCG companies. And similarly, consumer loyalty also in more recent years, we've noticed it has shifted towards a willingness to try niche brands, private label, which was always, I would say, a very small part of the consumption wallet. Today, it is becoming a larger and larger part. Hence, the only FMCG exposure we have in our portfolio is of a company called Tata Consumer, which is more of a capital allocator acquiring brands in new categories, and it generates more than half of its revenue through quick commerce, e-commerce, modern retail, which are channels of the future rather than relying on the standard Kirana store. So that's one example of paradigm shift. Also consider what the K-shaped economic progression of the last decade has meant for growth saturation in some of the premium categories today. So the K-shaped economic growth or recovery, whatever we call it, does mean that the middle part of the K, it doesn't grow as much as the top part of the K, right? And hence, as you move beyond the top 10% households in this country, which is roughly 3-4 crore households, the disposable income levels of the household, they drop so sharply that essential categories like, say, a premium undergarments, as an example, which is dominated by our erstwhile investee company, Page Industries, even such a category is failing to grow volumes in double digits, right? It's not that Jockey is losing market share and hence is not able to grow volumes beyond mid-single digits. The K-shaped recovery means this saturation of TAM beyond a point in some categories, not all, beyond the top 10% households. So that's another paradigm shift which has led to changes in our coverage universe. And then there's also a paradigm shift when it comes to, let's say, experiences instead of just products taking wallet share. So spends on luxury hotels, tourism, they've been skyrocketing. We all remember how Coldplay's concert was conducted in Ahmedabad and various other cities in India, making the band's world tour become the most attended tour globally, I think. There's another paradigm shift in the real estate space, which I mean, the healthcare piece is an outcome of that. Not just healthcare, when you look at hospitals, hotels, large format retail, these are all real estate heavy business models. Unit economics of these sectors, they were unprofitable across the sector pre-COVID and post-COVID. Several players in these sectors, they have turned their unit economics into sustainably profitable, at least in terms of, let's say, ROCE being ahead of cost of capital. I guess this has happened for the first time in some of these sectors, and it's quite a remarkable change in that regard. Now, what that does is,
sorry, Rakshit, if you can just go back, I have just want to clarify something. So the style of investing in CCPs, we are looking at companies which have some sort of a history, who have demonstrated have a demonstrated track record. Now, this would mean that these companies have been around for a while, fairly mature in their businesses. Now, how do you reconcile that with the fact that you're looking also for companies that need to be agile, so that if there is a dilution in traditional moats, then they are ready to kind of tackle that or take on any new competition or a new way of doing business or a paradigm shift, as you've called them. So what do you look for in companies to make sure that they have been around for years, but they are still as agile to take advantage of changes?
So effectively, what we are looking for is track record of decision making, which is reflective of consistency, discipline, even if unit economics of the here and now business hasn't had a 10, 15, 20-year history of generating revenue growth and return on capital employed above a certain threshold pretty consistently, right? So, for instance, let's take hospitals as an example, or Trent as an example in retail, which, as I said, are companies that haven't had unit economics being profitable till 5 years ago. Now, Trent has had a 27-year history of decision making, which you can break into different phases. And the most recent phase is at least 15 years old. It's just that in the reported accounts, you can't see it. And hence, there is that extra effort needed to understand the unit economics and the decision-making process. That becomes a very central part. The second piece is rather than being too glued to 10 plus years of history, if a business has demonstrated 5 or 7 years, but it has gone through several inflection points and demonstrated the agility that you're talking about in decision making, then that also tells us management quality around how to allocate capital, how to build and deepen moats. There are some of these cases where we start off as relatively smaller positions if the management historical track record isn't, let's say, 10 plus years or long. Position sizing comes handy in some of those cases, but no, on our willingness to build conviction around the drivers of consistent compounding. Rather than looking at the past, we are looking at the unit economics today and the decision making instead of fundamentals.
Great, that's answers it. Thank you. Please go on.
Yeah. So now, through all these changes, we've effectively doubled our coverage universe over the last couple of years, expanding both the number of stocks and the breadth of sectors in the CCP coverage universe. So just to reiterate, the concentrated nature of the portfolio hasn't changed. The number of stocks in the portfolio remains 15 to 20. And also, whilst 2 years ago, within the 15 to 20 stocks, we had 4 or 5 sectors predominantly in CCP. Today, we have exposure to 9 to 10 sectors. The aim is that we can get it to a level where almost all stock selection in the portfolio is uncorrelated risks. That is a far better way to reduce risk than just have a little bit of different macro drivers or different growth drivers that might be part of the index. Is the approach, is the sort of philosophy that we follow at CCP. Now, Coming to
Sorry,
valuation.
Rakshit, again, let me
Sure,
interrupt you. I
please.
think you are in your element here. But if you go back, right, the FY25 portfolio realignment point that you made here on this slide. Now, last year, I mean, that is FY25, when we saw this realignment, there was a lot of tax incidents that some of our clients had to face. Does it mean that going forward we'll see less of this, or should churn be similar as we go ahead? I mean, how would you tell our investors of what to look forward
Yeah,
going?
so it was 2 points on that. One, it was a one-off bunching up of churn in a relatively short period of time, which was FY25. And the second piece was the preceding 6 or 7 years for clients who had been invested for longer than 6, 7 years. The preceding 6, 7 years had very low churn, so unrealized gains were very high going into FY25. So one, the churn was abnormally high, and when I say abnormally, it is non-recurring going forward. Second, there was a booking of 6, 7 years of gains, at times even longer for some of them, which obviously led to the tax incidents being high. Going forward, we expect 15 to 20% churn in a typical year across cycles. Some years might have a little higher, a little low, but give or take 1 to 2 stocks in out every year, which is let's say 10 to 15% churn, and the rest of it hopefully rebalancing will add value through the rest of the churn.
Right. And every year you'll find new stocks now because you have doubled the coverage. So you have a kind of a larger buffet to
The
reach for.
choice
Is
is
that
more.
the way? Okay.
Correct. So the choice is more, which gives us agility around, uh, well, agility around disruptions, business cycles, valuations, even to an extent macro factors, although macro is not a very significant part that we have learned how to play. But particularly around valuations, business cycles, the agility is far greater with a wider coverage universe, which might lead to that extra 5% churn versus what we had previously guided.
Right. Please go on.
Thanks. So coming to valuation, Salil, you asked in the beginning. So particularly in the current environment, I think valuation discipline is very important. There are 3 pockets of the quality universe that we want to avoid investing in at a point in time. The first one is where franchises are undergoing a structural moderation in their earnings growth due to their target market or TAM approaching saturation, or competition coming in a way that starts overcoming the moats that used to exist. And yet the market has not corrected the valuation multiples. We'll avoid these as we believe that the market is ignoring the deceleration in fundamentals. There are some examples. Let's say if you look at many FMCG companies that used to be part of the quality universe, some of them part of our portfolio historically, some lenders, some discretionary consumption stocks, where I gave one example of TAM saturation due to the K-shaped. So those are some of the areas where a deceleration in fundamentals is the reason we'll avoid if valuations haven't reflected that. The second area is where there will be many high quality names priced to perfection with sort of all sorts of growth outcomes already priced in, zero margin of safety, and massive risk that any earnings miss can trigger a sharp derating. We'll keep these on our watch list, eager to invest because these are good quality, high growth companies. But we'll keep them on a watch list rather than in the portfolio. There are many internet companies with good unit economics today versus loss-making unit economics previously, sustainable unit economics today, but priced to perfection. There are many such companies from hotels, internet, and a few other sectors that belong to this category, which are in our coverage universe. The third category is cyclicals, quality cyclicals at peak valuations, right? So stocks that are rallying solely on external tailwinds. For instance, it could be something as simple as or as recent as government capex tailwind that they experienced in the last 3-4 years, and the market is extrapolating a cyclical 3 years government spend into a perpetual trend. We view these as classical traps, and will avoid. There are several cap good companies, some manufacturing plays for outsourcing that belong to this list, which we are avoiding at the moment. And whilst the markets are richly valued broadly, where do we find opportunities to invest? There's some examples. Firstly, where we expect a positive surprise in earnings growth. Now, these are areas where valuations, they may appear optically rich, but we believe consensus earnings estimates are too conservative, maybe. Best example, as I said, Trent, when we invested, where it was optically at 150 times, but it wasn't. We're willing to pay up for the sort of optical paying up for quality here, because the potential for earning surprises provides a buffer. Some of the recent examples, for instance, Asian Paints, where consensus expected low single-digit earnings growth for the foreseeable future. Obviously, optical P becomes high, and we stayed invested. There are some others. There's a pharma export play. There's a pipe manufacturer in our portfolio, which belong to this. The second area is where we expect valuation upgrades due to benefits from capital allocation decisions that the companies have taken. As in most of these cases, the market is not pricing in the potential benefits of capital allocation, because there would be possibly an initial drag from the capital allocation decisions, fixed cost in the initial years, and hence maybe the market is missing the inflection point which the business might be going through in their cash flow generation over the next few years. This is visible across a few stocks in our portfolio. So we've got a classifieds business, we've got a hospital, we've got a cash logistics business, etc., which are accelerating their capital deployment in different directions, and we are using that as an opportunity to load up more. So those are the areas where I would say we are gaining comfort. Looking at the portfolio's recent fundamental performance, second quarter FY26, the bar chart shows you that revenue, EBITDA, and EPS of our portfolio companies grew by around mid-teens to high teens. EBITDA was 19%, EPS was 12%. There was a gap there. Compared to this, Nifty 50 delivered lower revenue growth and lower EPS growth, 1 and 7. Also, when you look at the return on capital employed, it remains pretty robust, around mid-20s, with a very high reinvestment rate. You multiply the two, you can get effectively, if these two numbers sustain, ROCE and reinvestment rate, multiply the two, and that's effectively the ballpark earnings growth that such a business can generate if these numbers sustain. When it comes to valuation, yeah. Go ahead.
Sorry, no, please go on. I'll come back to you. Finish your valuation part.
Sure. So on valuations, our weighted average forward PE multiple is in the high 30s. Whilst this is a premium compared to Nifty 50, we believe it is fully justified by earnings growth and ROCE of our portfolio being more than twice that of the benchmark's long-term averages. And we are essentially buying into superior capital efficiency and growth resilience when you compare those multiples with the market. Salil, you had a question.
Right. So Rakshit, I'm looking at this chart, and revenue growth 15% and EBITDA growth is 19%. So clearly, these companies are improving their profitability, margins are on the rise. But the EPS growth is only 12%. So, what explains this difference? And, is this just for this quarter? Do you think there is something that's hiding behind these numbers?
Yeah, so we looked into it because that's a big gap between EBITDA growth of 19 and EPS growth of 12. It's a big gap even for the index, but also for our portfolio. So there were a couple of common themes that we picked up leading to the gap between EBITDA growth and EPS growth being there. One was a tax treatment related thing on a few companies. So for instance, Escorts, Aisha in our portfolio, there is a change in how the government started taxing long-term capital gains on debt mutual funds. last year at 12.5% without indexation versus earlier regime of 20% tax with indexation. And the companies gave effect to this change in Q2 FY25, which led to the base tax rate versus this year's tax rate being different. So that's why when you look at, let's say, so for Escort, the EBITDA versus EPS gap is 50%, 50. For iShare also, it's a very big gap. The second common trend was there are some companies in our portfolio where capex had been accelerated, and the depreciation effect of that as a result is coming in an accelerated manner, particularly Trent, Metro kind of retailers, where for a Trent, I remember that the depreciation rate went up by 67% YOY when their earnings and revenue were in the teens or 20s YOY for Q2. So that's again sort of a, first of all, non-cash, but more importantly, kind of a one-off. So I think EBITDA growth is representative, and next quarter onwards, the gap between EBITDA and EPS should narrow. Till last quarter, this gap wasn't as wide. So
Right.
it's a kind of,
while this gap between EBITDA and EPS, like you said, will narrow, but you also mentioned that depreciation has grown significantly for some of these companies. Now, if capex has already been done, then what are the chances that we'll see revenue growth now accelerating from this 15%? Is that a likely scenario?
Yeah. So, I mean, provided our call on management capability to deploy capital in efficient ways, it is not wrong on these companies, which is what we believe, that it is not wrong. Provided that call goes right, you'll get the asset turns on the new capex over a period of time, and that should lead to then, in a way, the revenues growing commensurate to how the capital was deployed.
Perfect. Great. Please carry on.
Right. Now, in terms of changes, so as we mentioned, FY25 was a year of reasonably high churn, but also we've been doing a lot of counter-cyclical rebalancing actively. This is where we are buying into pessimism and trimming optimism. So we increased position sizes in franchises like Trent, InfoEd, CMS more recently, where we felt the market priced in excessive pessimism. And to fund this, we trimmed exposures in some of our top contributors that had rallied significantly, such as Narayana and Aisha. Looking ahead, we see few structural tailwinds as well from the external environment. On the policy side, from the government, the recent GST rate cuts, if they do give a bolstering effect to areas such as auto, B2C consumption, which are reasonably allocated in our portfolio, then that's one area where we expect some tailwind from the external environment. And also, we are convinced that healthcare in particular is an area where over the next 10 to 15 years, India should see the benefits of early stages of structural rise in penetration levels. We are playing it through multiple angles. Hospitals has been added in the last couple of years. Diagnostics has been loaded up in the last couple of years. Health insurance is there, and even our pharma single stock pharma exposure that we have, it plays significantly into preventive healthcare oriented spends in future, the peptides, the GLP-1s, and various other such structural trends. So those are some of the external factors that we expect to benefit from. And last, but certainly not the least, the performance track record. I've given two charts, the standard one on top, and also to put some things into context, the NAV line at the bottom. What you can see in the lower chart is in the first 3-4 years of our existence, we had a good run up, both in absolute as well as relative terms. The line chart there, the blue versus red. And then came the 3-year period of FY22, 23, 24, when Nifty 50's EPS growth had shot up to 24% CAGR, which significantly outperformed our portfolio's EPS CAGR of 17-18%. And that led to a weak performance in the portfolio, both in relative as well as absolute terms. While some of this underperformance of the last 3-4 years was related to a slight delay in making changes to adjust to the changing paradigm of the Indian economy that I talked about. Some part of it was also related to a drag of quality as an investment style. And also in a concentrated portfolio with low churn and absolute return orientation, there will be periods of large gaps versus benchmark, both on the positive as well as the negative side over 1 to 3 years. Net over the long run, it obviously has to beat benchmarks, as I said earlier on in the webinar, which is what we aspire to do in future. In terms of the outlook, we believe that quality as a style factor should do well over the next few years, unlike the last 3-4 years, because as the broader economic growth moderates, as I mentioned, Nifty 50 EPS CAGR was 24% for 3 years, FY21 to 24. As that moderates to currently, it has been in mid-single digits. The gap in that kind of an environment, the gap between average companies and exceptional ones, it'll widen. And in a moderating economic growth environment, companies that rely on internal strengths, deep moats, prudent capital allocation, they will differentiate themselves from those reliant on only external economic tailwinds. Having said that, as I mentioned, we remain vigilant of elevated valuations in the broader indices, combined with weak earnings growth for the broader benchmark in the recent quarters, and hence there remains a risk of a market correction. Some of it we've seen in the more recent days, but that's relatively small compared to the risk that might exist. And we are trying our best to position our portfolios to be resilient against it via the resilience of fundamentals and the growth of fundamentals of the investee companies. So I'll stop there. Thank you for your time. We can take some questions, Salil.
Sure. Right. So, folks, if you have questions, you can type them in the Q&A box. We'll try and take as many as we can. But Rakshit, before we let the question queue kind of assemble, I have a couple of questions. Right now, you mentioned that macro is not something that you kind of let drive the portfolio, but I'm sure there might be questions on there's so much happening, around the world, and how resilient is the portfolio to that, right? So first, my question would be, let's say there's this whole Indo-US trade deal that's playing on everybody's mind, right? It's happening today, tomorrow it's not happening. So you think that is something that you are worried about? How would you kind of say the portfolio is positioned if a deal happens or if it does not?
Yeah, so I mean, that's a binary event. First of all, we don't know which way the event itself will turn into in terms of its outcome. Secondly, then it's very difficult to predict basis the event's outcome, what will be the impact on the broader market, on our investee companies and their fundamentals. There's so many dependents or so many uncertainties in that chain of thought. So it's very difficult to position the portfolio for a particular event, particularly like a geopolitical event of Donald Trump and the taxes, etc. What we do is, these are broader constructs which play out in the face of external crisis for quality investing in general. First and foremost, if you are investing into companies which have the ability to offset macro headwinds with market share gains, that provides some resilience to fundamentals. Second, if we are investing in companies which are cash generative and management has had a demonstrated track record of prudence in capital allocation decisions, then they will make every crisis, they will try to benefit from every crisis rather than being on the receiving end of such external events. Third, if we are orienting our portfolio a little bit more towards predictability, I mean, obviously, predictability doesn't mean linear line on an XY plot, but if the fundamentals are reasonably more predictable than otherwise, then automatically we'll be more oriented towards areas such as, let's say, a domestic consumption or diversified exports, so that single country reliance or single customer reliance, etc., is taken care of. So those are some of the areas where typically I would say quality investing would have some shock absorbers. But at the end of the day, beyond what the management teams do with their companies, it becomes an opportunity even from a portfolio construction standpoint to use position sizing to your benefit in case share prices they react wildly and irrationally to some of these external events.
Sure, right. And there's one more question that I had, and I can see that some people on the call also have is how are you playing the age of AI? Is it still too early, too many changes we should kind of keep away, or if you have some thoughts on that?
No, very good question. So there are different types of risks and benefits, risks and rewards that AI brings to any portfolio, our portfolio, our investee companies, etc. The first and foremost piece, the low-hanging fruit, is companies which are more process-oriented, companies which have used technology historically as a way of life. So let's say, typical example, Bajaj Finance, right? Asian Paints, right? The newer variant of HDFC Bank rather than the 10-year-old variant of HDFC Bank. So there are those companies where they embrace technology. Using AI for efficiency gains becomes something that they would latch on to quicker and better compared to competition. Healthcare, the hospital that we have, it's got Narayana has got technology as a backbone to its operational execution. So that's one level, which is efficiency gains using AI. The second piece is, can you actually make a product around AI, which is pretty radical, let's say, right? So this is where, I mean, we don't have too much of exposure to such internet companies or such AI companies, but InfoEdge has been a relatively more recent entrant, and we've been loading up every time it dips further. InfoEdge for the classifieds business is using AI as a product. It's still at a pilot stage, but there's a lot that they can achieve if this pilot succeeds in terms of using AI to offer different value adds than what human beings had been offering in jobs classifieds. And then it has a venture business which invests into internet companies, some of which are listed, some of which are not. Part of that investee company pool from the VC fund is also playing on AI based value adds to the customer. So that's the second piece. I would say relatively early days in companies finding success in building moats around AI in that regard. There's then a third piece which I think will become relatively more commoditized. Maybe I'm wrong. Which is using AI for marketing, creating adverts. So instead of running, let's say, 10 advertising campaigns in a year, you run 100 because the time it takes to create an advert campaign, it shortens so much. It's an extension of the efficiency part. We are consciously looking at companies which are latching onto such opportunities more and more. So those are the broadly, I would say, three buckets. We are acutely aware of operational efficiencies being part of business execution for our portfolio companies, because only then can you sustain scale with growth over several years, at times several decades. And hence, any technological evolution, if it is not being embraced by our portfolio companies, we would be worried, and we'll accordingly either cut the position size or reduce our earnings growth estimates, or both, and maybe not even invest if we see scalability challenges because of lack of adoption of technology. So it remains in the center in different ways.
Right. Now we have a few questions around the valuation part of it, right? And so the question is on, how do you look at valuations? You look at cash flows, you look at, P multiples. And related to that, if you could stay on the slide where you're showing the Nifty versus the portfolio valuation multiple, there's a specific question on what that difference was. But to specifically answer the question, how are you looking at valuations? What is your process? What is your method?
Yeah. So there are different facets to it. Unfortunately, valuation is not maths. It is more a science and an art combination. It's not maths. So the first and foremost piece is on the DCF. What are you? What is the share price implying? Reverse DCF. That's the starting point. If the share price is implying, let's say, 20-year longevity, theoretically it might be possible, even practically it might be possible, but it becomes a case where it's priced for perfection. Perfection might be delivered, but any negative surprise in the interim can lead to a massive drawdown. With a much wider investment coverage, a much wider coverage universe for the portfolio, they would be equally good EPS CAGRs, maybe 1% or 5% lower quality of the business with the same EPS CAGR expectation, but much cheaper valuation, a better risk-reward trade-off. Those would be the calls that we'll be making in that kind of a situation where a 20-year, 25-year growth has been baked in. Price to perfection is what I would categorize it as in the middle row of this slide. The second element of valuation is, once we are comfortable that not 20 years, maybe 7, 8, or 10 years is priced into the current price. What we look for is what is baked into the next 3 to 5 years of expectations, and where can there be a positive or negative surprise? Can it be around valuations? Is the quantum of quality underappreciated? Are there growth drivers which are underappreciated? Are there risks which are too conservatively priced in, etc.? So if we can see through that these are the various factors which are baked into next 3 to 5 years earnings growth, and there can be a positive surprise around that, it is something which we'll add on to the valuation piece. The third one is certainly P multiples are a reference point in a way, as in companies with greater longevity would have traded at richer PEs. If you see, let's say, taking a simple example, say a Narayana, when we invested in it, we could clearly see a massive opportunity around lack of understanding of Cayman Islands' ability to deliver cash flows and even growth in the valuation. It was the cheapest hospital, but we could also understand that it is cheap because the market believes that Cayman won't fire. We traveled all the way to see the asset in Cayman Islands and came back convinced that look, this part of the valuation piece is certainly up for earning surprises at some point in future, and we loaded up. So it's a combination of these three things, I would say: reverse DCF, expectations investing, if you call it, and P multiples relative to what the market is giving to similar businesses in the same industry elsewhere.
Got it, right. Since we're on the topic, there's one question from Rajnikant, right? And he asked, do you look at valuations for each company individually and say, already, if this passes all my tests, then I bring it in the portfolio? Or do you look at the portfolio level and say that overall portfolio should be a certain multiple versus the market, or whichever way you look at it? So some question on how to construct a portfolio when the valuation, keeping the valuation aspect in mind.
Yeah, no, for us, it's bottom up. I mean, for the slides, I'm giving a summary picture here at the bottom right that look, it's 39 times P multiple versus whatever, 21 times for Nifty 50, etc. But that's not the way. We don't start from that. That's just the end game. The starting point is each stock. Look at the valuation proposition there. look at the earnings growth proposition there, the fundamental, the quality of the moat, the catalysts, and then position size. Basis the position sizing, weighted average comes out. If it is significantly out of whack, the weighted average P multiple, then obviously there'll be a debate discussion internally, and we'll see if the bottom-up stock picking has any abnormalities in some shape or form. But otherwise, it's bottom-up. It's not top-down.
Right. Then, Rakshit, there are a couple of questions on the portfolio fundamentals. Right now, historically also, the portfolio fundamentals have been usually fine, right? You have always gone for a certain minimum level of growth, ROCEs about 20% and so on. But those have not delivered, right? So from now on, if as an investor, if I were to look into the future, then with these same fundamentals, what could change?
Yeah, so good question. We actually did a pretty detailed newsletter on this about 9 months ago, if I'm not wrong, where we quantified portfolio fundamentals and how that did or did not translate to what extent it did in the past to performance. So what has happened in the past is we've delivered between 17 and 18% EPS CAGR over the last 7 years for portfolio. When you look at, let's say, the start of every year portfolio, what it delivered as EPS and stitch it together. So 17 to 18 has been the outcome on fundamentals. When you add back, let's say, fees and expenses to the since inception return, you get to between 15 and 16. So there's a 200 bips gap between the rate of growth of the portfolio fundamentals and the portfolio itself. I would say out of that 200 bips gap, half of it is maybe we were not so conscious of the foreseeable risks around either external factors or valuations, or so for instance, when COVID was at its peak, we ended up being on the beneficiary side of very uncorrelated businesses, all benefiting from COVID, from the same event. So whether it be Molnupiravir for DVs, or whether it be Dr. Lal RT-PCR tests, or whether it be the work from home apparel wear for Page, or so on and so forth. And so these were, I mean, apparel and Molnupiravir are not correlated, but they got both a boost from the same event. And when that event went away, we should have been a little more agile than we were to react to it. So some of that 200 bips gap between earnings growth and the pre-fees and expenses is explained by this. And I guess the rest of it is maybe portfolio valuation derating, some of which we can recover from, some of which is a learning from the past. Going forward, I do expect, I mean, we've become more agile, not just in making these stock level calls, but even executing portfolio changes in terms of the way we conduct ourselves whenever a churn is on. All of this, according to me, should add better value going forward than it did in the past. Going forward, the portfolio fundamentals, I do expect to deliver mid to high teens, at least, if not better, in case the external environment improves. At the moment, the external environment, given where it is, mid to high teens. And then if we can do a little bit better via portfolio construction, take off fees and expenses, we should at least be able to match the earnings growth rate more or less, right? So that's the explanation.
Right. Thank you. Srinivas Rao asked about, you identified 2 or 3 themes in those paradigm shifts, right? So if you're looking at, although he's asking, what stocks you will add, I'm assuming that's not what we want to talk about. But some examples of, experiences versus, what regular consumption, or internet companies showing better unit economics. So you can cite some examples where, great businesses are being built in India. These could be future, CCP type of businesses getting built.
Yeah, so experiences is certainly, I mean, it's a start, I would say, at an economy level. I don't think we are anywhere close to where maybe spend on experiences would be in the more developed world markets. But it's a start for sure. So I would say 20 years ago, nobody wanted to pay for experience. 10 years ago, in some areas, people wanted to pay for experience. Let's say, at least in healthcare and diagnostics, I remember moats were built initially 10, 15 years ago on turnaround times, which is part of the experience in a way, of the phlebotomist coming to your home, so timely delivery of reports, etc., etc. So that was 15 years ago in the most essential areas. I think post-COVID, we've certainly seen a kind of a shift in a few categories at least. The wallet share towards products versus the wallet share towards experience. That piece has certainly shifted. The best example here is, hotels is a great one. It used to be far more cyclical than what it has been over the last 5-6 years, from the demand side, where demand previously used to be largely foreign travelers, a little bit of business travelers. People would travel only to cities where they had their own relatives and hence could do a holiday without spending too much. Today, not just in Goa, but wherever else you go to a Taj or something, 30,000 rupees room, 40,000 rupees room, it's in good demand, right? So that is one part of it. Self-pay patients in hospitals going for room rentals, which are pretty high. People willing to buy from air-conditioned retail formats. These are all outcomes of experiences of services being in demand compared to 5-7 years where they weren't. Now, what that has led to is, because the footfalls for some of these service-oriented or experience-oriented businesses were relatively lower or less structural than they are today, the unit economics was not as productive, not as cash generative as it is today. So that does create inclusion into quality investing universe, and hence, again, a widening of our coverage universe. Typically, experience-oriented moats are more difficult to build. Once built, some of their variants are pretty pretty deep. So if we do find companies that over a period of time build experience-based more services, etc., it can actually be a very good, consistent compounding fundamental story there.
Right. We have a series of questions from Aziz, Sebastian. A couple of them have been answered on how we look at valuations and cash flows, and a couple of others. But there's one interesting one here is that does this paradigm shift stand, how you've articulated your portfolio style and philosophy, does it change the investment process? Do you still read up as much, let's say 10 years of annual reports, look at previous cycles and all of that, or now you're just looking at what is going to happen in the next 5 years?
It doesn't change much, actually. So let me put it this way. Over the let's say 2005 to 2020 period, that 15-year period, we would have always got 20-year annual reports for a company we would pick up in the portfolio, because quality coverage universe was narrow in general, not just for us. It was reasonably narrow during those 15 years. The drivers of growth were those that existed by doing same old for the preceding 10-15 years as well, and hence a 20-year annual report reading was available and relevant. Today, the only thing that changes is there might be some companies. So, for instance, when we look at internet, hotels, hospitals, now InfoEdge has a very long history, so we do still read 20 years of historical annual reports. But for some of the other internet companies in our coverage, the annual reports don't exist. The company never existed for 20 years. So to that extent, the execution of the process does change, but not the intent. The intent remains the same, that if we can get long enough history of decision making by the management, we want to study that. We are very keen, very curious to know how it has happened historically. It does mean that with a relatively shorter history, in some cases, maybe you can say the risk element goes up because disruptions are becoming more frequent. If traditional modes are diluting, etc., the risk around sustenance, it does go up a bit, which is why we used to have a 13 to 15 stock portfolio till 2 years ago. Today we have a 18, 19 stock portfolio, and that increase in the 3 to 4 count in the portfolio construction in number of stocks is one solution. The other solution is the uncorrelated risk aspect. So previously, if we had to build a portfolio around 4 or 5 industries, then let's say for simplicity's sake, 20 to 25% of the portfolio would be linked to similar external risks from the same industry. Today, that number is roughly half because the number of sectors in the portfolio are 9 to 10. So to that extent, there's an offsetting or there's a risk mitigating factor in place, but the risk might be a little higher. Other than that, the approach towards doing research, the only change that has happened is we rely far more on AI to read not just annual reports, but also various other types of documents which would have otherwise taken us a far longer time. So same size of our research team is doing double the coverage universe with equal depth. The widening of the coverage universe hasn't led to bandwidth constraints on our research team.
That's why AI is doing my job, and I'm here hosting a webinar.
The head of research, yeah.
Rakshit, on this slide, so there's one question from Manu G, and we don't have much time, so I'll just take one of them. Is that on dilution of traditional modes? Now, in case of Asian Paints, distribution was considered like a solid, strong mode, right? Has that been disrupted? Right, the general feeling is that yes, it is no longer a mode. How do you see it?
It is less of a mode, but not that it is no longer a mode. So let me explain. So when technology was not democratized, right? Today, technology is far more democratized than it was 20 years ago, 30 years ago. Then Asian Paints pushing itself to get access to technology and use it in the business was a far greater gap in capability, which is demand forecasting and hence faster turnaround time versus peers, right? I would say this lasted in a very wide manner till 15, 20 years ago. Over the last 15 to 20 years, as access to technology has become easier, cheaper, even for smaller companies, and I mean, whether it be SaaS, being the reason why it is accessible at scale for cheaper cost, or just awareness of management teams in terms of how process oriented they need to be, or people just learning from Asian Paints and replicating what Asian Paints have done. Every CEO in the paint industry is ex-Asian Paints, so on and so forth. So whatever be the factor, the gap has been reduced over time between Asian Paints and peers. Having said that, the definition of the moat has evolved. So when I look at Asian Paints today versus peers, moat is not limited only or solely to speed of delivery. Speed of delivery remains the fastest, although not a 4-day versus 1-day gap between peers. Today, it might be a 2-day versus 1-day gap, but the gap does exist and it does still matter to the dealer. What has happened is on top of it, the product portfolio is in some areas significantly wider. That's one element added. A significant element added is ability to generate demand for the dealer, right? This is something that Asian Paints used to do in relatively smaller magnitude till a couple of decades ago. Today, helping the dealer and the painter get access to new leads or lead generation for the channel is a very significant part of the moat. So that has offset the dilution of the distribution mode piece a bit. Then comes the servicing piece. So painting as a service at least has been significantly successful at Asian Paints, where if you go for home painting solutions, not home improvement solution, as in not their home decor piece, but the home painting solution, which has become very widely popular. You will get trained painters who would know, first of all, the most optimal way to use the product. They will not cut corners, or they will not paint only the corners in a way. And they will do the job with less of a hassle, quick turnaround times, shorter durations of project completion, so on and so forth. Availability of labor would be better, etc. Right? So to that extent, servicing is something that others don't yet offer. And Asian Paints does offer in especially the larger cities, in some cases even the smaller ones. So the moat is evolving, but yeah, it is not as deep in distribution as the only dimension.
Right. So we have time for one last question. There are a few on this. Rakshit, is on the diagnostics sector, right? It's too crowded, is what the general perception is, and generally we see that crowded spaces, it's very difficult to make too much money. And we have two of those stocks in the portfolio, right? So how do you justify having them in the portfolio?
Yeah, no, good question. So stocks are two stocks are a little different from each other, and hence the answer applies a little differently. But let me put it this way: diagnostics has low barriers to entry. It is not, as a result, number of players are too many, but market shares are not too fragmented, right? So if you look at the organized industry market, those shares haven't been fragmented over time. They have only been more concentrated over time. But barriers to entry are low, and hence nobody stops anyone from setting up a lab and get a third-party supply chain to collect samples and deliver at even a third-party lab at times. So that is one part. Now, the barrier to entry here remains that diagnostics is a very important part for the doctor to rely on, because the doctor's treatment, success, and hence the doctor's reputation depends on what was diagnosed in the beginning. Otherwise, wrong diagnosis, wrong treatment, wrong everything else for the doctor, right? So the doctor becomes a very big influencer in the middle. Trust of the doctor cannot be built overnight. And to that extent, the incumbents doing quality diagnostics, which I won't say the quality of testing is radically different between the number one and number two player, but it is radically different between the top 5 and the next 10 players. So that becomes a very big moat. The second piece then becomes is a proper supply chain logistics piece, right? So turnaround times, which is convenience for the patient, it becomes a more important moat progressively as wellness, which is more B2C rather than via doctor for diagnosing, let's say, a more senior level therapy or treatment. So treatment is more B2B because it happens via doctor. Wellness is preventive, and it is more B2C. The more B2C this industry becomes, the more the importance of turnaround times, quality of service, etc. The service, the experience that we were talking about, it matters, and that is also where someone like a Dr. Lal is ahead of competition. And then diagnostics has a very interesting challenge that if it can be overcome, another layer of moat can be built, which is it is a highly cash generative business, especially the pathology one. And the brand doesn't transcend geographies easily. It is hyper local. What that means is you need to allocate cash, whether organically or inorganically. It is not a given that, unlike a Unilever, everybody would know about the brand the moment you open a collection center in a relatively newer geography or a newer town, right? So to that extent, organic and inorganic expansion across geographies, it becomes relatively more difficult in diagnostics than in other industries because it's hyper local, and hence in the cash generative industry, then capital allocation becomes quite important. There are success stories for even the Dr. Lal, and there are hiccups that even they had around Suburban. So accordingly, we have to play selection of businesses here. When it comes to Vijaya is radio plus path. So radiology includes all these MRI, CAT scan, and X-ray and ultrasound, etc. That's 40% of the business. Why it is very different? When you look at this whole evolution towards more chronic than acute, evolution towards more preventive than treatment oriented, evolution towards, I mean, even things like cardiology, oncology, etc. All of these becoming far more widely prevalent. The presence of radiology is rising in all of these dimensions. Right? These are different dimensions I talked about. All of these evolutionary dimensions are moving towards a combination of radiology and path, rather than just complete blood count being done because you had a fever, which is pure path. Right. So to that extent, even Dr. Lal has now started to expand in the NCR with radiology investments more recently. But Vijaya has a very strong unit economics, which it has scaled up, not just in Hyderabad, but now in multiple cities, 3 more outside Hyderabad. Particularly Bangalore has been a big success story more recently. And that opens up doors to delivering growth through geography expansion for Vijaya in a more difficult type of a radio plus path combination. Why am I calling it difficult? It is more capital intensive. The ROCs are relatively lower, and hence mistakes can be far more costlier. Right. So that's why we have 2. Both are different, but yeah, it's not as easy as it seems. Having said that, capital cycles will come and go in this industry, certainly. So when Thyrocare IPO'd in 2016-17, there was a price war, and it affected Dr. Lal a little bit on the fundamentals, but more on the share price. When all these Healthians and Radcliffe and Tata 1mg, etc., came in 2022-23, I'm sure many of our clients underwent the drawdown of Dr. Lal in the portfolio. Like we did with Dr. Lal last time, we doubled down when it fell. That is one solution. But next time, when the capital cycle is on the rise from the supply side, maybe we'll preemptively even trim exposure and then increase it at a more appropriate time.
Great. Thank you so much, Rakshit. Before we close, one quick announcement. For those of you who don't know, we have a complimentary, a free asset allocation plan for whoever is interested. You can log on to plan.marcellus.in. That's plan, P for Patna, LAN.marcellus.in. You can leave your details and our team will get in touch with you. And Rakshit, there's one suggestion for you. The presentation was nice, but seemed a little too technical. So maybe next time you can try and make it a little simpler for everybody to understand. Thank you everybody for joining us today. And if you have any more questions, please write into us at sales@marcellus.in, and we'll try and answer as many as we can. Thank you and have a very good night. Thanks, Dr.
Thank you, Salil. Thank you.